Mr. Victor Choi is Executive Director, Head of Markets and Investment Solutions Asia for Credit Agricole Private Banking. Hello, Mr. Choi.
Nice to meet you today, Piotr.
What are the main economic and political factors today that investment managers in Asia should be taking into considerations?
I think what we are having in the global markets right now is a divergence emerging among the global markets. First, you have the Fed, which is approaching the end of the QE program, and the market is expecting that the first rate hike could come around the middle of next year. So this is definitely a good news in a way because U.S. cannot be hiking interest rates if its recovery cannot be sustained, right? So first you have the U.S. which is exiting from the stimulus program, whereas on the other hand, what we're having is Japan and Europe continue to be intensifying their stimulus program, and so this kind of divergence is something that is important in the decisions making going forward.
How are these factors likely to affect FX and precious metals markets in Asia?
Again, the Fed will be in the driving seat to drive the market going forward, as always. As we also agree to the consensus that the Fed tightening could happen around the middle of next year or late next year, we believe that will continue to be a bullish scenario for the US dollars. Okay, and because at the end, when we are talking about relative economic performance or the interest rate on the US dollar, I mean the divergence between the dollar and other major currencies is really diverging between dollar and euro or dollar and the yen. So we continue to hold our bullish view on the US dollars against the euro and the Japanese yen. This is pretty much the same case for gold as well, because historically gold has been negatively correlated with the real interest rate of the dollar, and so by default, when the US dollar interest rate goes up, then it will exert some pressures on the precious metals. We are firmly of the belief that equities is still the asset class of the choice, because we are still in the middle of the expansion cycle in the US, which is still the growth engine of the world. So what we believe in, we will continue to be overweight in equities. When it comes to the fixed income, we are having a kind of neutral to bearish views on the long-term interest rates, on the long-term bond of US dollar. So actually what we are having is to keep the duration short for our fixed income portfolios. And we are now trading at about 2.4-ish, 2.5% on the 10-year US dollar interest rates. We think that there should be a good chance for it to go back to like 2.75 to 3% for the next 12 months. And so because of that, then our position is going to have a short duration in our portfolio. We'll also keep a very close eye on the German bond yield because of the ECB easing bias. The bond yield is now very low. For the 10-year wise, it's now sitting at or below 1%. And so we don't believe that such a divergence will expand too much between the US and the Euro 10-year interest rates. So in a way, this very low bond yield will also bring some downward pressure on the 10-year US dollar yield as well. And so because of that, we are only mildly bearish for the 10-year US dollar bonds. When you look at the global markets these days, the geopolitical risks still exist in quite a large parts of the world. So this is something that will be alert by myself, definitely. And second, the asset prices around the world, especially on the real estate prices, is also quite high around the world. So this is something that I will also be paying attention to.